Welcome to the show, Scott Sumner. Today is May 13th, and we're here for another COVID economic update. Scott is an active economic blogger at themoneyillusion.com and at EconLog. Scott, people are concerned that there's a big disconnect between asset prices on Wall Street and the economy on Main Street.
I would say several things about this. The performance of the stock market has surprised me a little bit, but I think that's partly because this crisis has maybe indirectly strengthened the relative position of corporate America relative to small businesses. So normally the stock market sort of goes with the economy. And even in this case, it's fallen during this crisis, but it hasn't fallen maybe as much as you might have expected. And that might be because, let's just take one example. A company like Amazon might benefit from people buying more things online, while little small family business retailers might be shut down, right? So the retailers are not in the stock market, but Amazon is in the stock market. And I would say that the U.S. stock market in particular, has so many large cap tech companies that have done fairly well in recent years. That explains some of the discrepancy.
Well, when the Fed announces an asset purchase and it's not, as far as you're concerned, it's not enough, is it maybe that the first thing that happens is that asset prices rise, and it's a secondary effect that it helps people, in the economy?
Right. So this raises an important point about a misconception I see all the time.
Okay.
So if there's a QE program and the stock market goes up, people will say, well, the QE is just like juicing the stock market. It's just helping investors. But in fact, any program of any sort that the government has that's effective in promoting recovery from a depression, including the most left-wing socialist program you can imagine almost, is going to likely help the stock market, right? So you could inject all of the money into the homeless community, and that money will find its way through the economy, and stock prices will probably go up as a result. So you cannot use a rising stock market to automatically assume that there's something wrong with a QE program. What I would say is you do not want your stimulus programs to be unfairly favoring the rich or the more comfortable, but it is inevitable that the market will respond more quickly to stimulus than the real economy. Jobs will come back gradually, but a stock market will respond within seconds to the announcement of any effective stimulus program.
What did you mean when you said the 2009 recession, the Fed disproportionately helped the Wall Street and not Main Street in that case?
I was referring to a more specific program of interest on bank reserves. The Fed injected a lot of money in the banking system, but they didn't want it to stimulate aggregate demand. So in that case, that was not QE. They were not trying to stimulate the economy at that point, just provide liquidity for banks.
I see.
So they paid interest on bank reserves to prevent market interest rates from falling. In other words, they didn't want it to have a stimulative effect. They were still worried about inflation. They just wanted to help the banks. To a cynic, that looks like they're trying to help Wall Street, not Main Street. Now, I don't think that was the goal. The Fed, I think, was well-intentioned. They wrongly believed that the problem was the banking problem. If they could fix that, the recession would go away. The actual problem was a lack of aggregate demand, but I think it was an honest mistake by the Fed. But more cynical people will say the Fed, favors the large banks over the Main Street. And you can see how those conspiracy theories would get out there given the disproportionate impact of what was done in late 2008.
It was an honest mistake, but the truth of the matter is it was tight money, and that was wrong.
Yes, right.
All right, now let's go to where you think we are and where we're going.
It's awful hard to say where we are because this is such an unusual shock. As you know, this is a recession or depression, I guess, created by a real shock. And I think that's the first time in my life that that's happened in the United States. Generally speaking, in past recessions, the problem has been too little spending. And if you inject enough money into the economy where people spend more, you solve the problem. In this case, we have actual sort of barriers whatever they are, whether it be the lockdown or people's aversion to going shopping, that prevent the production of goods and services. So it's a different kind of depression. You know, when I look at the vast differences between the pandemic and sort of similar countries like Australia and Canada, I think to me that really drives home the point of how hard it is to predict. I can remember a couple months ago when those two countries were suffering about equally. Now I think Canada's hit about 100 times harder than Australia in terms of daily fatalities. And so I'm not going to predict the pandemic, but I'll talk about what I know about the economic side. My own view is we put too much emphasis on fiscal stimulus, which I think is costly and not very effective. And we've done too little monetary stimulus, and especially not exactly the right type of monetary stimulus. We're seeing a lot of evidence of a sharp fall in inflation. And that's not something that's supposed to happen during a supply shock. And it's also not desirable. Ideally, you'd want the rate of inflation to increase during a negative supply shock, such as during the oil embargo of the 1970s. At a minimum, you'd want no change in the inflation rate. But under current monetary policy, inflation is actually likely to fall. But if you allow the inflation rate to decline, that makes the debt crisis even worse. The Fed's most powerful tool is level targeting, which means promising to bring the price level back to the previous trend line. They're aiming for 2% inflation. So they really need to commit to an inflation rate that, a price level that's, say, 4% higher 2 years from now, or 8% higher 4 years from now. That's the sort of commitment from the Fed that I think would help the credit markets a lot. In fact, it would help the credit markets more than some of the programs that have been rolled out so far. So the way to think about fiscal stimulus is the federal government, the Treasury, is taking pre-existing money from the public, either through taxes or borrowing, and redistributing that money to other people. You're moving money around with fiscal stimulus. Usually it's done through borrowing. So we're planning to borrow, 3-4 trillion, whatever, this year from the public to disperse the funds to other members of the public. That's fiscal stimulus. Monetary stimulus is creating new money that wasn't in the economy previously and injecting that new money into the economy, usually by buying financial assets like treasury bonds. This time around, they also intend to buy some riskier assets like corporate bonds, in addition to treasury bonds. The creation of new money is a much more powerful tool for stimulus if it is done correctly with the appropriate target. And that's where level targeting is so important. My worry is that the Fed is going to be doing some things that look very impressive, aggressive use of tools, but in the wrong direction, not towards a level target, but towards a growth rate target. And in that kind of environment, those same tools are much less powerful. In the last decade, we've been targeting inflation at 2% a year, but we've been falling a little bit short each year. Under level targeting, you promise to make up for those misses with higher inflation in the future, so that the long run average inflation rate is 2%. Because they haven't been doing that, and the markets are somewhat skeptical of the near future, expectations for inflation going forward have fallen well below 2%. We don't know exactly where they are, but I'm pretty confident in saying they're significantly below 2%.
I'm wondering about the communication. So when the Fed says, we're buying $1 trillion of assets, how do you know whether that's the right amount, whether they're going to make another announcement the next week, whether what they're really targeting? They just say, we're buying $1 trillion of assets. Isn't that just a big guessing game?
The best evidence we have is the market forecasts. So if you look at the market forecasts, those forecasts suggest that that is not enough. However,
Which forecast? Like, what is the real-time response from the market that tells you that when the Fed gives a number, that it's not enough?
If you look at a wide range of indicators, including tip spreads, including the price of commodities, including private sector inflation forecasts, if you look at a wide range of indicators, they all are sort of pointing in the same direction. they're all suggesting, at least as far as I know, that we're likely to have below 2% inflation, probably well below that over the next few years. So while we can't be certain, these forecasts, these market forecasts and other private sector forecasts by economists are really the best we have to go on. I think at a minimum, we want to do enough so that our best guess is that we will in fact have the inflation rate that we want to have. So if we're aiming for 2% inflation per year over the next 2 years, we should do enough where that's essentially the best guess, the consensus forecast of the market or the market plus private economists, however you want to do that forecast. My argument is no plausible forecast today has us on target. So while we can't be precise in terms of where we are, we can be pretty confident that we're not sufficiently expansionary at the moment to be likely to hit our target. This concept is called targeting the forecast. You essentially want your expectation of where you're likely to be the same as your goal of where you would like to be. Whereas traditionally the Fed would do sort of QE programs with relatively safe assets without much expectation of a loss, this time around they're engaging in additional purchases that are somewhat riskier or loans that are somewhat riskier. And as a result, it's sort of sliding a little bit over the line into a fiscal aspect of policy as well, not just pure monetary. A pure monetary policy merely injects money into the economy. If there are losses, those are absorbed by the Treasury. They become essentially a part of the national debt.
Now we have to do some short-term triage, right? The asset purchases kind of, the commitment to bring prices up to 2% growth per year. That's a long-term raise the river and raise all boats approach, right? But what should be done in the short term to help the pain of the immediate economic situation?
Okay. Well, first of all, let me make one point, try to make this pretty forcefully. The mere promise of returning to the trend line, the commitment to do level targeting, if you will, is the most powerful short-term thing we can do today.
Not long-term, but short-term.
It would have the biggest impact on the markets, even though the actual implementation of this would occur over a period of time. So the actual steps that the Fed would take would occur over time, but the mere announcement of this would have a powerful effect on the markets. I can give you an analogy here. A few weeks ago, the Fed announced an intention to become involved in what's called the junk bond market, the high yield or riskier bonds.
Corporate bonds.
And corporate bonds. This market immediately rallied very, very strongly. And a week later, people were commenting that the Fed hadn't actually done anything. It hadn't bought any junk bonds. The mere announcement that it was intending to do this in the future caused that market, which was crashing at the time, to dramatically turn around and become more liquid, and companies were, again, able to issue debt and so on. So often the announcement effect is more powerful in its impact on the markets than the later concrete steps that the Fed takes to implement that policy.
Right.
It's hard for a lot of people to grasp. Most people want to focus on what I call concrete steps, QE, negative interest rates. These are just tools. The more important criteria here is the destination. When the Fed sets a new and different destination, the effect of that is much more powerful than the specific tools. So if you think of the amount you have to do, people often talk in terms of ammunition. How much ammunition does the Fed have? How much can it do, like in terms of QE purchases? With level targeting, you can get the same results for the economy with a much smaller amount of QE.
Yeah.
Some cases you might not have to do any QE at all.
Yeah, because the threat is credible.
Right. But if it's not credible, then you commit to what I call a whatever it takes approach. And once you start down that road, if you show a real commitment to it, the markets will see that you're serious. And in effect, you actually can get the results with very little effort.
Right.
And there's even scenarios you can imagine where announcing a level target would result in you'd have to contract monetary policy.
Sure.
Even though it's higher.
Right. Not right away, but you could imagine.
Right away.
Oh, yeah.
So let me give you an example.
Okay.
And this is a little bit fanciful, but if the Bank of Japan were to announce a policy of high inflation, 5%, 10% a year, something like that,
right,
and say they're going to do level targeting, and they'll do whatever it takes to hit that target. As soon as that policy was credible, the demand for Japanese yen would fall sharply. Right now in Japan, there's an enormous amount of yen in the economy. The monetary base is about 100% of GDP. That's enormous. People are essentially sitting on huge piles of cash. Now, the reason they're willing to do that is because inflation and interest rates in Japan have been near zero for decades.
Yeah.
So it's not very costly.
Yeah.
But if you have an economy with 10% inflation per year, people do not want to sit on large quantities of zero cash.
Right.
So what would happen is if you had a credible announcement to shift to 10% a year inflation in Japan, people wouldn't want to sit on all this cash, and velocity would immediately go up sharply.
Right.
And in order to prevent an overshoot towards hyperinflation, the Bank of Japan would probably have to reduce the monetary base by more than 90%.
Yeah, you'd have to throttle back fast.
Because there'd be so much less demand for base money.
In a 2% announcement kind of a situation.
Well, that's a little more of a gray area. So if Japan went to a 2% inflation and did level targeting, that's still a higher inflation rate than they've had in recent decades. So that probably would actually reduce the demand for base money a lot. But it's possible what might happen in that scenario is that the Bank of Japan would have to increase the base in the very short term to make its commitment credible. And then when people saw they were serious,
then pull back.
The demand for base money would fall because people don't want to hold as much cash and bank reserves in an environment with 2% inflation as they'd hold in a 0% inflation environment. So once that threat became credible, even for 2% inflation long term, the demand for money in Japan would fall, and the Bank of Japan could actually reverse its QE programs. They could pull money out of circulation.
Sure.
Because there would simply be less demand for base money. So how much money people want to hold depends on the inflation environment, the nominal interest rates in the country.
Right.
But that's ultimately determined by the central bank itself.
Right.
So there's an interesting sort of interaction between central banks and the public. The central bank sets the long-term inflation rate. The public then decides how much money it wants to hold, and then the central bank has to react,
adjust,
to that public demand for money to make its promise credible.
Right. I'm going to ask a bunch of questions that I see people asking. So, first of all, the Fed balance sheet now is around $7 trillion.
$7 trillion is about a little over 30% of GDP. So certainly the balance sheet here is much smaller than Japan or Switzerland or countries like that.
Right.
But again, I think we have to be wise in the way we do this. Just doing more QE without changing the underlying policy regime is not the most effective way to address the problem. So if we switch to level targeting, that same extra $1 trillion you mentioned is much more effective in stimulating higher inflation expectations. And again, the goal is to make it so at a minimum we don't have a fall in inflation during this crisis. Monetary policy cannot solve the actual, social distancing depression we're in. But if the depression is associated with deflation or disinflation, it makes the debt situation even worse. And one thing monetary policy can always do, always and everywhere, is create inflation. That's the one thing it can do. It can't magically create jobs, but it can always create inflation. And at a minimum, we should create as much inflation as we're promising or targeting and not at this time of all other times allow it to fall below 2%.
Yeah.
Now,
Right.
again, the best way to do that is to have the correct regime in place, which is level targeting. But in terms of the tools, yes, QE is a very good tool for hitting the target once you've set the appropriate target. Another option, which the Fed is reluctant to do, is negative interest rates.
Right.
And you can think of these as think of a simple supply and demand for money model, because people get confused about what QE is all about, what negative rates are about. In my view, the best way to think about monetary policy is this. Creating inflation is exactly the same as reducing the value of money. You're trying to reduce the purchasing power of money by 2% a year.
Right.
Okay. Now, the basic laws of economics say there's only two ways to reduce the value of any asset: more supply or less demand.
Less demand, right.
QE is more supply. When we do QE, we add to the supply of money in the economy. So other things equal, that'll tend to reduce the value of money. But right now, it doesn't do it very much because we're exchanging basically near zero interest reserves.
Velocity is so low, right? Velocity has dropped off a cliff, right?
Right. So in addition to increasing the supply of money, you can reduce the demand for money. One way to do that is negative interest rate on bank reserves, right? So a negative interest rate is really a tax on bank reserves. You're telling banks, if you hold bank reserves, you must pay to the Fed X% per year in interest for the privilege of holding these bank reserves. That discourages banks from holding deposits at the Fed. Now, there is a problem there as well. If you push that too far, banks might ultimately say, well, if you're going to tax us at too high a rate, we'll just hold currency in our vaults instead of deposits at the Fed. And most economists thought that would happen very quickly if they went to negative rates. But for some reason, institutions of all sorts, including banks, don't like to hold very large quantities of currency. So many institutions have chosen to hold reserves at negative rates, or if you go into the bond market in Europe, investors have preferred to hold German government bonds at a negative yield rather than hold euro currency in a bank vault at a zero yield. And that's a side issue of all the reasons people don't want to hold large amounts of currency. But anyway, this puzzle as to why rates are able to go negative is an interesting one. But the bottom line is it does seem like central banks can, to some extent, charge negative rates. So that's one method that can be used. I don't necessarily think it's the best approach. I think level targeting combined with QE might be enough to solve the problem without negative interest rates. But it's something that we could at least keep in mind as an option if all else failed.
Last week, Janet Yellen said, once they've pushed down interest rates across the curve pretty close to zero, there's not much more they can do. That's kind of a remnant of old Keynesian style thinking at the Fed, isn't it?
Yeah, so Keynesians tend to think in terms of monetary policy through the lens of interest rates. So they think low interest rates are expansionary. They encourage people to borrow and buy things. And my view of monetary policy is very different. It's all about the supply and demand for base money. So often a low interest rate policy is actually a contractionary policy because it's reflecting a tight money policy that's created deflationary expectations. And those deflationary expectations have driven interest rates to zero.
Relative to the natural rate.
Right. So I call this focus on interest rates reasoning from a price change. There's a tendency of people in general to make the mistake of looking at the change of a price and drawing an implication from that change. A famous example is if people look at, say, rising oil prices and assume that means people will consume less oil. In fact, rising oil prices might be associated with increased consumption of oil if the rise in the price is caused by increase in demand. The same is true for monetary policy. A lower interest rate might be expansionary or it might be contractionary, depending on whether that lower interest rate is caused by the effect of injecting more money in the economy, extra liquidity, or if the lower interest rate is caused by falling inflation expectations. And in my view, the recent fall in interest rates has been virtually 100% caused by falling inflation expectations, not monetary stimulus. So it is not a hopeful sign for the economy that the Fed cut interest rates. Simply a reflection of the fact that monetary policy is too tight, leading to falling inflation expectations. And we need to sort of get ahead of the curve. Ideally, we would actually want interest rates to be higher, but only because the economy was strengthening, not because the Fed artificially pushed them.
Right.
That would not be the right policy. Rather, we want enough monetary stimulus to create enough inflation so that the free market interest rate naturally rose above zero.
Right, so the natural rate goes up.
The mistake Keynesian economists make is to focus too much on the target rate set by the Fed and ignore the fact that much of the movement in the natural rate is itself driven by expectations of Fed policy.
Right.
So a dysfunctional central bank that the markets can see as dysfunctional, like the Bank of Japan, the markets see that it's not doing enough to create inflation. That creates bearish expectations. That lowers the natural rate of interest in Japan. So focusing only on the target rate set by the central bank misses the deeper issue of movements in the natural rate of interest, which itself are often created by mistakes at the central bank.
Would you say Powell has gotten over a lot of that, and he's now willing to get into the fight and do more of what it takes? His message might not be perfect. He might not be talking about targeting, but he is, using the tool of asset purchases much more aggressively than talking about interest rates. So does that reflect a change in the models at the Fed?
I would say an incremental change. So if you went back to early 2019, there was certainly evidence that the Fed had learned something from previous mistakes. During early 2019, the economy was booming. Unemployment had fallen to 3.5%, like the lowest in 50 years. The economic models that economists use, the Keynesian models, said there's no reason to cut interest rates. The economy is booming. The markets said the opposite. The markets were signaling a lot of concern about the economy due to the trade war and other issues. In fact, the Fed looked at the market indicators, not at their models, and they cut interest rates 3 times in 2019. We would have normally had a recession in 2019 if the Fed had followed their standard, computer models of the economy, using concepts like the Taylor rule and so on, and setting interest rates. They probably would not have cut interest rates. We would have had a recession. And because they did cut interest rates 3 times, we ended up with the longest expansion in American history. And probably the expansion would have continued this year as well, if not for the epidemic. We had very strong January and February employment numbers, for instance. The economy was looking great. I think the misfortune for the Fed is, even though they've improved, they've made incremental improvements in their model. They pay more attention to markets. They understand these things better than they did 10 or 20 years ago. This shock was so large and called for such a radical response that it was just too much for the Fed.
Why has the dollar risen against the major currencies? That happened right away.
One thing is that the dollar itself is sort of like an international safe asset in a crisis. So there's a lot of demand for dollars during a period of international stress. There are some aspects of the US economy that have perhaps done better than some other economies. For instance, if you look at the high-tech sector in the United States, it seems to have done pretty well during this crisis. The NASDAQ stock market has done pretty well. And that reflects a lot of these companies that actually might see increased business during an epidemic.
The Fed has $7 trillion in treasuries. How many $1 trillion in treasuries are there, and to what extent are they affecting the price or the supply and the demand of treasuries for people who want safe assets?
First of all, the Fed holds both treasuries and mortgage-backed securities.
Yeah.
The amount of treasuries in circulation is, I think, in the 20 to 25 trillion range.
Yeah. Yeah.
However, the Fed would not be able to buy all of them. They'd have to leave a significant amount in circulation because these are safe assets that are used for a variety of purposes in the financial system.
Right.
On the other hand, there's also, I think, over $10 trillion in mortgage-backed securities. So now you're talking maybe close to 35 trillion relatively safe bonds that the Fed can buy. The real fundamental issue here is, does Congress want the Fed to do whatever it takes to hit the target? So, there's all sorts of options we have here. If Congress wants the Fed to continue to have a 2% inflation target, one option is to shift to level targeting. That allows you to have a smaller balance sheet. Another is to allow negative interest on bank reserves. That allows you to have a smaller balance sheet. Another option is to raise the inflation target from 2% to 3 or 4%. That allows you to have a smaller balance sheet. So the balance sheet will grow faster over time. It'll grow at 3 or 4% a year instead of 2% a year on average.
Yeah. But
it'll be a smaller percent of GDP because the demand for money will be lower. See, the Fed balance sheet as a percent of GDP reflects basically how much you and I want to hold in cash as a percent of GDP, and banks also. So let me put it this way. Imagine a country where on average people wanted to hold 5% of their income in the form of cash. Make it real simple. We'll ignore bank reserves.
Okay.
In that case, the Fed balance sheet would be 5% of GDP because the public as a whole would be holding 5% of national income in the form of cash.
Why is there a correlation? I don't understand what's the driver there? Which is driving which?
Okay, the nominal amount of money in the economy is determined by the Fed, but the real amount or the fraction of GDP held by the public is determined by the public.
Yeah.
Right?
Right.
So let's just do a real simple thought experiment to show you how this works. We all think we determine how much money we hold. We may think that, but we don't. The Fed determines how much we hold. And you might say, what are you talking about? I get to go to the ATM machine and put $100 in my wallet if I want to.
Right.
No, the Fed is determining how much money is in your wallet. What you are determining is the real quantity of money in your wallet. So if you have an economy where the public on average holds $100 in their wallet.
In other words, I think you're saying the buying power in your wallet.
Right. So let's imagine the Fed doubles the money supply. And you say, well, wait a minute, I want to hold $100, not $200. What are you going to do with this money? You're not going to burn it. You're going to try to get rid of it by spending it. But the fallacy of composition says that as individuals, we can get rid of excess cash, but as an entire closed system, we cannot do so. So if the Fed doubles the money supply to 200 per capita from 100 per capita, the only way for the public to get rid of those excess cash balances is to spend them so aggressively that the price level doubles, at which time their real cash balances have returned to the original $100. So it's sort of an illusion, a cognitive illusion that we determine how much money is in our wallets. No, we don't. We determine the real amount of money in our wallets.
Right.
The Fed determines the nominal amount. Right. So when the Fed raises the inflation target from 2 to 4%, maybe not immediately, but over time, people will decide at 4% inflation, they don't want to hold as much cash as at 2%. Okay? Just as an aside, the main issue here is actually going to be with bank reserves. The public's demand for cash won't change all that much at 4% inflation. It'll be a little bit lower. But banks will hold a lot less bank reserves at 4% inflation than at 2%. And as a result, the Fed's balance sheet as a percent of national income will become smaller. If we're worried about the balance sheet getting too large, we're worried about the Fed going out and buying common stock and office buildings and things they shouldn't be buying in order to hit a 2% inflation target.
Right.
There's just a multiple set of ways you can avoid that problem. You can go to level targeting. You can add in negative interest on reserves. You can raise the inflation target. And ultimately, at the end of the day, if all else fails, if Congress says, no, we don't want higher inflation targets. No, we don't want negative interest on reserves. No, we don't want the Fed buying corporate bonds, only safe assets. And ultimately, you have to throw up your hands and just say to Congress, okay, then you do it with fiscal stimulus.
Right, good luck. Right.
But my complaint is fiscal stimulus is the first thing we're doing in this crisis. And we haven't even come close to exhausting any of these other options, which are all far more efficient than a fiscal stimulus and do not increase the national debt. Do the fiscal stimulus where it's needed, maybe for the unemployed, for the the medical situation. You look at all these areas where fiscal stimulus is needed for things that monetary policy doesn't cover, right? Specific needs for the economy. I think we should at least be prepared for the possibility that at some point interest rates might return to normal and not run up debts, very large debts, on the premise that we'll never again have to pay interest on those debts.
Now, this gets to something we were talking about last week, and I want to bring that forward, about the unwinding of the asset purchases or the reduction of the Fed's balance sheet. When the economy starts to heat up and when those the natural rate of interest starts to increase and we have more nominal GDP, really, to put it simply, then the Fed has to watch out for too much. And then that's the point when they see the economy starting to overheat, that's when they would unwind these purchases, right?
Right. So they have two options. They can unwind the purchase, or they can continue with a large balance sheet but pay interest on bank reserves. But that second option is no free lunch, because in order to have the money to pay interest on bank reserves, the Fed needs to have a portfolio of securities they bought that provide interest to the Fed. So I say this because you hear a lot of talk about helicopter drops. Why don't we just have the Fed dump the cash on the economy?
Yeah.
The problem with that is that with a helicopter drop, if you have to reverse the transaction in the future, there's no like big vacuum cleaner that can suck the money back out of the public.
Right.
You have to buy it back. The public will run around grabbing the money you dump out of helicopters, but if you ask for it back in the future and say, that was just a loan, they won't give it back. So you really want to buy bonds that you can sell in the future if you need to pull that money out of circulation, or that provide interest to pay interest on bank reserves if that's your way.
But here's the question. If you got $7 trillion, can't you say, well, we're never going to have to sell more than $5 trillion. We're never going to get below $2 trillion. So that is actually room to do a percentage amount of, let's say, future asset purchases or increasing money supply as a helicopter drop. Not all of it, but say 20, what if 20% were, because then you can always use your balance sheet to tighten money again. Or do you need to have 100% of it on the balance sheet so you can unwind 100%?
Right. So it's pretty safe, I guess, for the time being. Well, let me put it this way. What you're really talking about is the part of the balance sheet that is backing the liability of currency in circulation. So the monetary base has two parts. About $2 trillion is currency in circulation, and the rest is electronic bank deposits at the Fed. The electronic deposits at the Fed are very volatile. Those were almost zero before the Great Recession. So they're the part that the Fed really needs to be worried about in terms of the potential going bankrupt in the future. They do have the cushion of currency, that the demand for currency is fairly stable in the past. So you could sort of argue that they don't need securities to back up that currency stock because it's not likely they'll have to pull that currency out of circulation.
Yeah.
But even there, I'm going to offer one cautionary note. All this talk about helicopter drops that I see in the media and in the blogging world, the Twitter world, and so on, a lot of the discussion proceeds as if it's sort of like, well, it's all just free now anyway. The interest rates are zero. We can just dump all this money out there. There's no cost. And I'm actually sympathetic in one sense to these people. I'm not with the conservatives that oppose monetary stimulus. I think monetary policy needs to even be more
Right.
more stimulative than it is right now.
Right.
We're not doing enough monetary stimulus.
Right.
But I'm not sympathetic to the helicopter drop approach because it's one of those sort of too good to be true ideas where it's presented as if it's costless. Like nobody has to pay for this. We're just printing money and dumping it out of airplanes. And people's instincts, I think this is one area where like uninformed high school dropouts probably have better instincts than a lot of experts. I mean, most average people would think this is just too good to be true. There's going to be some price to be paid, printing a lot of money and dropping it on the public. And of course, we're not talking about this literally. We're talking about printing money and giving it to people in tax rebates and so on, not literally out of a helicopter. But the basic idea is that there's no cost here, that no one really has to pay for this, which is sort of how it's presented in some of the discussion. I find it completely implausible.
So to raise prices, to hit an inflation target, you want all of the asset purchases to be backed up by assets so that 100% of that can be unwound later.
Yeah, if necessary. And if you don't want to unwind it, if you want to keep a big balance sheet, then you use those assets to provide funds to pay interest on bank reserves.
On reserves. What will you say, and you understand it really well, but some people really have reacted in saying, this is the end of the dollar, this is we're the beginning of hyperinflation.
Right, so that's the opposite side now. If I was debating, with the helicopter drop people on one side, then the side you're talking about is more common among conservatives. One thing I would say is they made the same false predictions during the Great Recession. And a number of us, both in my group, the market monetarists, and also Keynesian economists like Paul Krugman, warned them that they were mistaken in their view that the QE programs were going to lead to a lot of inflation. So my view is that for the same reason that the QE program, the Great Recession did not lead to a lot of inflation, what's being done now is also likely not to lead to a lot of inflation. If we get higher inflation in the future, in my view, it will not be based on anything the Fed is doing right now. Rather, it'll be based on one of those sort of generational swings in temperament that occur every so often, where one generation reacts to the mistakes of the previous generation. So we had the generation of the Great Depression that was, the older people were too contractionary in the 30s. The young generation saw that when they grew up and got positions of power after World War II, they instituted more expansionary, inflationary policies. My generation grew up with a great inflation. We saw those mistakes. We became hawkish, and we pushed policy in a more hawkish direction. Eventually, we pushed it too far in the Great Recession. Now you have a generation of millennials that see how the boomers screwed up monetary policy in the Great Recession, and even now, I would argue, and have heard so many, the crying wolf about inflation, so many examples of people crying wolf about inflation, that they're dismissive. They don't even know what inflation is, or high inflation. And so eventually that generation will take power, and they'll keep pushing so far in the other direction that maybe eventually they will create some inflation. So I think it will be, when it happens, it'll be because of one of these generational swings where people have forgotten the lessons of the previous cycle.
But the balance sheet will still be there, so they can always cool it off. That's not a big deal.
Yeah,
if they want to.
It'll be more of a question. They'll say inflation is the lesser of the evils. So when the inflation comes, and I don't think it'll be here in the near future, but if and when it comes, it will be because a whole generation has decided that the cost of holding it down in terms of debt problems or employment or whatever is just a price they're not willing to pay. And they'll make their own misjudgment.
All right, now let's wrap up with market monetarism and targeting nominal GDP, because it's very possible that unemployment will be at 25, 30%, right? I mean, we're looking at some extreme numbers.
So far, I've been talking about, at a minimum, trying to keep inflation from falling below 2% on average over the next few years. That's sort of in line with current inflation targeting approach, but shifting to level targeting, promising to make up for mistakes. But the market monetarists want them to go further and actually allow inflation to rise above 2% when economic growth falls below normal. And we can do this with a nominal GDP target. So nominal GDP growth is the sum of inflation plus real GDP growth in the economy. So you might pick a 4% target for nominal GDP growth, with the idea that maybe we'll get roughly 2% inflation and 2% real growth in the long run. Under that kind of system, when real growth falls, you try to raise inflation above 2%. And the goal here, there's really two goals to keeping nominal GDP growth stable. Nominal GDP growth is the variable that is most important in the labor market and the financial market. And the reason is very simple. Two very important contracts in the US economy are almost always nominal contracts. And those are employment contracts and debt contracts.
Right.
Right?
Right.
So you promise to pay a certain nominal wage, you promise to repay a loan a certain nominal amount.
Right.
When national income falls, nominal national income falls, it's harder to repay nominal debts and you get a debt crisis. It's harder to pay nominal wages and you get mass unemployment. And throughout history, those are almost always the two worst symptoms of falling nominal GDP. It was true in the Great Depression, high unemployment, bank failures. The Great Recession of 2008, high unemployment, bank failures. We see it over and over again throughout history. And there's a real danger we could have the same. We're certainly going to have high unemployment, and we're certainly going to have some defaults on debt contracts. And some of that's unavoidable because of the medical problem.
Right.
But by continuing to try to maintain growth in nominal GDP in 2021, 2022, I realize there's nothing that can be done this month or next month, realistically. Right. It's going to be very low. But looking ahead next year, the year after, trying to get growth in nominal GDP roughly on the target path will help greatly in terms of people having enough income to repay debts, and it'll provide businesses with enough revenue to pay workers' salaries. So as the lockdowns begin to ease, and my feeling on this is that what we're going to have is sort of a gradual shift over time, where what's initially a real shock becomes increasingly a problem of inadequate aggregate demand. So as the lockdowns ease, there's still going to be a lot of unemployment because people will voluntarily social distance. They'll be reluctant to go shopping or trips and so on. But over time, that will probably become less of a problem. And I don't know, this is where we get into the issue of how that'll play out. It could go in cycles, we don't know. But certainly there are at least some economies like East Asia, Australia, New Zealand, where it looks like this summer, people will be able to go about their business without much fear of getting sick and dying. The rate of infection is pretty low in some of these countries. So their domestic economies are likely to recover satisfactorily, although their export sector will still be very badly crushed by the global recession. So if we think in terms of those countries, you could envision a pretty high employment level with sound monetary policy. In the US, I'm a little uncertain as to how many jobs we can create with adequate monetary stimulus. It depends how much people go to restaurants to eat out, to go to get their hair cut, and how much businesses are able to put into place kind of procedures to reduce risk, partitions, wearing masks, things that make people feel comfortable enough. And it's even going to be regional. People are going to be more fearful in New York City than Wyoming let's
Sure.
say going to a
And
restaurant.
it will depend whether we have good treatments and
Vaccines,
sure.
all that.
Sure.
My personal opinion, by the way, is that the cost of this recession is so great that we should pull out all of the stops, like including like paying people to do challenge studies of vaccines,
Right.
even if there's a risk involved, a health risk. Anything we could do to address the medical crisis more quickly, even if it did involve some risk,
Right.
I think it was a sensible thing to do.
Right. There's a lot of nuances in challenge studies, but for sure. But we've lost 80,000 people already, so you don't want to do nothing in a crisis. Okay, I just want to wrap up just quickly. What you would like the Fed or Powell to do right now would be to make a very clear commitment to 4% nominal GDP growth for the next forever.
Yeah, a level target where you promise to get back to the trend line of 4% growth.
Right.
You're going to miss this quarter, obviously, very badly, but over time, say 2021, 2022, get back on target. Right. Second choice, if that's too radical, is to do a level target at the price level. Now, one advantage of a price level target is it's less controversial with, say, Congress, because you still formally have that 2% long-run inflation rate that you've had all along as your goal. You're just using a different technique to achieve it, level targeting rather than growth rate targeting. So it can be sold as the same policy done in a more effective way, which makes it less controversial. And so I keep mentioning that because I think that's actually the more likely option if the Fed goes this route in the short run this year. I think the nominal GDP route is probably just too controversial, but I hope I'm wrong. I hope they do the nominal GDP target.
Let me ask though, if they magically committed to 4% nominal GDP growth forever right now, would that most likely in most scenarios without complete disasters give us a V-shaped recovery eventually?
It would almost certainly give us a V-shaped recovery if we didn't have any real barriers in the medical field. So for instance, go back to the Great Recession. In the Great Recession, there was no barrier to shopping or vacations or eating out, right? In that recession, I believe we would have had a V-shaped recovery with level targeting. Absolutely. And I think that was our biggest mistake in the Great Recession. America has had many, many V-shaped recoveries from deep recessions, very deep recessions, 82, 1921, et cetera, and several others I could point to. It's not impossible, but if there's a lot of social distancing, I don't think we're going to get a full recovery in employment until the medical situation improves somewhat. Like if people are just like unwilling to get in airplanes and take vacations, do lots of things, monetary policy can only do so much. And there, the goal should be to mitigate or reduce the debt crisis, reduce the unemployment situation somewhat by just ensuring we have enough demand out there, enough income being earned, so that we're not exacerbating the medical problem with an additional drop in aggregate demand. We don't want to add insult to injury.
Thank you, Scott. I really appreciate your insights and your views, and I hope some of this becomes more mainstream because I think your thinking has been at least inspirational to me and many other people, and I hope more people will listen to your views.
Well, thank you for inviting me, David.